Accounting basics explained for beginners. Have you ever wondered how successful businesses always seem to make the right financial moves? Well, here's the key. It's all about understanding accounting and business management principles. When applied correctly, these principles can turn your business into a success story. Curious about this secret sauce? Stick around and grab a pen and paper. By the end of this video, you'll have the key points you need to grow your business. So, what is accounting? Accounting is the backbone of any successful business. It can be defined as a professional activity that involves recording, summarizing, and analyzing a company's financial transactions. Imagine running a business without knowing where your money is coming from or going. Accounting gives you this clarity. In simple terms, accounting helps business owners, managers, and other stakeholders make informed decisions by providing accurate, reliable, and timely financial information. This information forms the basis for everything, from daily operations to long-term strategic planning. Accounting covers various types like managerial, financial, cost, tax, public accounting, and more. But when it comes to business, most people talk about financial accounting. Liabilities. Liabilities are obligations or debts that the company owes to external parties. This includes loans from banks, payments to suppliers for goods received, and accrued expenses like utilities that haven't been paid yet. Equity. Equity represents the ownership interest in the company. It's the difference between assets and liabilities, showing what would remain for shareholders if all debts were paid off and assets were liquidated. The accounting equation. The accounting equation is like a balance scale that shows how a company's resources are financed, whether through debt or the owner's investment. It's a fundamental concept in accounting that helps keep track of what a business owns, owes, and how much of its assets belong to its owners. Here's the equation: assets, liabilities, plus equity. This equation must always be in balance. Here's why. Assets are on one side of the equation, representing everything the company owns that has value. Liabilities and equity are on the other side, showing how the assets are financed, whether through borrowing, liabilities, or the owner's investment, equity. Example: imagine you start a business by investing $10,000 of your savings, equity. You also take out a $5,000 loan from a bank, liability. With this $15,000, you buy equipment, assets, worth $15,000. Now let's apply the accounting equation. Assets, equipment, CR $15,000. Liabilities, loan, CR $5,000. Equity, your investment, CR $10,000. If we add up both sides of the equation, see assets $15,000, see liabilities $5,000, plus equity $10,000. Both sides balance, confirming that the company's assets are financed by either what it owes, liabilities, or what the owners have put in, equity. Why it matters. The accounting equation is crucial because it provides a clear picture of a company's financial health. Lenders use it to assess the company's ability to repay debts. Investors use it to see how much of the company they own and its overall financial position. Managers use it to make decisions about expanding operations or managing cash flow. Journal entries. Journal entries are the first step in the accounting process. They are records of individual financial transactions in chronological order. Each journal entry captures the details of a transaction, including the accounts affected, the amounts debited and credited, and a brief description. Example of a journal entry. Let's say a company pays $1,000 in rent for the month. The journal entry would look like this. Date, March 1st, 2024. Description, paid rent for March. Accounts affected, rent expense, debit, cash, credit. Amounts, rent expense debited $1,000, cash credited $1,000. This entry shows that the company has increased its expense, rent expense, by $1,000 and decreased its cash by $1,000. General ledger. The general ledger is a master record that contains all the financial accounts of a company. It organizes transactions from journal entries into specific accounts, such as cash, accounts receivable, inventory, accounts payable, equity, revenues, and expenses. Example of the general ledger. Continuing with our rent payment example, the journal entry will be posted to the general ledger. Here's how it might look. Rent expense account, date, description, debit, credit, March 4, 2024, paid rent for March, $1,000, cash account, date, description, debit, credit, March 1st, 2024, Paid rent for March, $1,000 in the general ledger. The rent expense account shows a debit of $1,000. The cash account shows a credit of $1,000. The key difference between journal entries and the general ledger lies in their functions within accounting. Journal entries serve to document each financial transaction as it happens, ensuring that all details like accounts affected, amounts debited, and credited are accurately recorded. This step-by-step logging guarantees the completeness and accuracy of financial records. On the other hand, the general ledger acts as a comprehensive repository where all these journal entries are categorized into specific accounts such as cash, accounts receivable, and expenses. It provides a cumulative record of each account's balance, offering a clear overview of the company's financial position over time. For instance, when a business pays rent, the journal entry details this transaction by debiting the rent expense account and crediting the cash account. Subsequently, the general ledger aggregates all such entries into respective accounts, reflecting the total expenses incurred and the remaining cash balance. Financial statements. Financial statements are important tools that show how well a company is doing financially over a certain time. They help managers, investors, and creditors understand different parts of the business. Balance sheet. A balance sheet presents a company's financial position at a particular date. It lists its assets, things it owns, liabilities, obligations it owes, and equity, ownership interest. For example, if a company owns a building, asset, and owes money to suppliers, liability, the balance sheet shows these figures. It helps stakeholders understand how much the company owns versus how much it owes, which is critical for estimating financial stability and making investment decisions. Income statement. Also known as a profit and loss statement, the income statement reports a company's financial performance over a specific period, such as a month, quarter, or year. It lists revenue, money earned from sales, expenses, costs incurred to generate revenue, and ultimately, net income, profit or loss. For example, if a company sells products, revenue, and pays for raw materials, expenses, the income statement summarizes these transactions. Investors use it to gauge profitability, while management reviews it to evaluate operational efficiency. Cash flow statement. The cash flow statement details how cash moves in and out of a company during a defined period, typically categorized into 3 sections. Operations, cash generated or spent on core business activities, such as paying salaries or receiving payments from customers. Financing, cash from borrowing, loans, or issuing shares, as well as payments like dividends to shareholders. Investments, cash from buying or selling assets like equipment or securities. For example, if a company takes a loan, financing, buys new machinery, investment, and receives cash from customers. Operations, these activities are reflected in the cash flow statement. It helps stakeholders understand how effectively the company manages its cash, which is vital for financial planning and liquidity assessment. Shareholders' equity statement. This statement tracks changes in a company's equity over time. Unlike the balance sheet, which provides a snapshot, it includes share capital, money raised by selling company stock; net income, profit after deducting expenses; dividends, portion of profit distributed to shareholders; retained earnings, profit remaining after dividends are paid. For instance, if a company issues new shares, increasing share capital, earns profit, increasing net income, pays dividends, reducing retained earnings, these movements are recorded in the shareholders' equity statement. It helps stakeholders understand how profitability and capital transactions impact the company's overall financial position. Principles of financial accounting. There are a total of 8 principles that form the foundation of financial accounting practices. These principles make sure that financial statements are reliable, comparable, and useful for decision-making by stakeholders like investors, creditors, and managers. Let's take a look. Accrual principle. This principle says that revenues and expenses should be recorded when they are earned or incurred, regardless of when the actual cash is received or paid. For example, if a company sells goods in December but receives payment in January, it records the revenue in December when the sale occurred. Cost principle. According to this principle, assets should be recorded in the books at their original cost when acquired, rather than their current market value. For instance, if a company buys equipment for $10,000, it records it at $10,000 and not at any higher or lower value. Consistency principle. This principle requires that accounting methods and practices used by a company should remain consistent over time. It ensures that financial statements are comparable across different periods. For example, if a company uses the straight-line method to depreciate its assets one year, it should continue to use the same method in subsequent years. Economic entity principle. This principle states that a business should be treated as a separate entity from its owners or other businesses. This means that the transactions of the business should be kept separate from the personal transactions of its owners. For example, if the owner of a business uses personal funds to buy something, it shouldn't be recorded as a business expense. Matching principle. The matching principle requires that expenses should be recorded in the same period as the revenues to which they relate. For example, if a company makes sales in January, the costs associated with producing those goods should be recorded in January as well, even if the actual payment for those costs is made later. Going concern. Principle. This principle assumes that a company will continue to operate indefinitely unless there is evidence to the contrary. It allows accountants to prepare financial statements under the assumption that the business will continue operating and fulfill its commitments. For example, when preparing financial statements, accountants assume that the company will not suddenly close down. Full disclosure. Principle. According to this principle, financial statements should include all necessary information that could impact the decisions of users of the financial statements. This includes explanations, notes, and other pertinent information for transparency. For instance, if a company is involved in a lawsuit that could potentially affect its financial position, it should disclose this information in the notes to the financial statements. Conclusion. Remember, mastering these accounting basics is important for guiding your business toward financial success. Accounting isn't just about numbers. It's about understanding your business's financial health and making wise decisions. Use these insights to track your finances, communicate clearly with stakeholders, and plan for future growth. Don't forget to like, subscribe, and hit the bell icon to stay updated with our latest videos. Share in the comments which principles you're already applying in your business. Your feedback matters.